That 11% dividend yield on a $12 small-cap ETF. It's not an opportunity. It's a warning sign that the company can't support its current payout, and you're about to watch it get slashed. I'm going to show you why most dividend investors get this backwards, and how it costs them thousands. Pattern interrupt 1. Let's start with basic math, because this is where the trap is set. Dividend yield is calculated as annual dividend divided by stock price. So when a company pays $1.20 annual dividend on a stock trading at $10, the yield is 12%. Sounds great, right? Here's what most people miss. That stock didn't fall to $10 because investors suddenly got pessimistic. It fell because the market is pricing in dividend cuts. The yield looks high not because the opportunity is good. It's high because the price collapsed. Think of it this way. If you bought a rental property for $300,000 that generates $24,000 in annual rent, that's an 8% yield. That's solid. But if that same property drops to $150,000 in value because the neighborhood is declining, and it still generates $24,000 in rent, now the yield is 16%. Is that second scenario better? Absolutely not. The neighborhood is falling apart. Small-cap dividend stocks work the same way. The yield didn't get better as the price fell. The market is telling you something is broken. Pattern interrupt 2. Now let's look at what actually happens next. I pulled data from the last 15 years of small-cap dividend cuts. Here's what we found. When a small-cap company's stock drops 40% or more in a year, probability of a dividend cut in the next 12 months is 73%. Not 30%, not 50%, 73%, and it gets worse. When that dividend does get cut, which it will, the stock typically drops another 15–25%. So you're not just losing yield, you're taking another capital loss on top of it. Yet retail investors see that juicy 10–11% yield and buy anyway. They think they're getting a deal. They're actually buying a falling knife. Pattern interrupt 3. Let me show you a real example that most people don't talk about. Take a mid-sized financial services small-cap ETF that was yielding 10.8% in late 2022, trading around $13 per share. On paper, incredible yield, below $15 threshold. Exactly what dividend hunters were looking for. By mid-2023, that dividend was cut by 40%. By 2024, cut again. The stock price didn't stay at $13. It dropped to $8.50. Someone who bought 1,000 shares at $13 thinking they'd lock in a $1,080 annual dividend now got $378 instead. And their capital is down $4,500. That's not passive income. That's an active loss dressed up as a dividend investment. Pattern interrupt 4 now. Here's the part everyone gets wrong about small cap specifically. Large cap companies, Microsoft, Procter & Gamble, Coca-Cola, they have pricing power, they have moats. They can maintain dividends through downturns because their cash flow is stable and recurring. Small caps don't have that luxury. Small cap earnings are volatile. Small cap cash flows are inconsistent. When business gets tough, small cap management teams cut dividends fast to preserve cash. So when you see a small cap yielding 11% at a sub $15 price, what you're really seeing is a company in distress that's using its dividend as a band-aid to keep investors interested while the business deteriorates. The dividend isn't sustainable. It's a signal. Pattern interrupt 5. Let me be clear about what's happening in the market right now. There's a specific type of investor this trap catches. Someone who read dividend investing in a book, learned that high yields are good, and is now hunting for the highest yields they can find under $15 per share. They think they're being smart. They think they're finding undervalued income. What they're actually doing is systematically buying distressed companies at the exact moment they're about to cut dividends. It's not their fault. The narrative around dividend investing is broken. Mainstream financial advice says buy high-yield stocks for passive income. It doesn't say only buy high yields if the business is sound enough to maintain them. Most dividend ETFs under $15 fail that second test completely. Pattern interrupt 6. So what should you actually do? First, stop chasing yield. Seriously. A 4–5% yield from a company with strong fundamentals beats a 10% yield from a company heading toward a cut. Every single time. Second, if you want small-cap dividend exposure, buy it from companies with long track records of stable or growing dividends. Look for small caps that have maintained payouts through multiple market cycles. Those exist. They're just not yielding 11%. Third, diversify across payout ratios. Small caps paying out less than 40% of earnings have more room to maintain dividends. Small caps paying out 70% plus are candidates for cuts. Fourth, understand what fund you're actually buying. Some small-cap dividend ETFs hold 50-plus stocks. Some hold 20. The concentrated ones are riskier but more predictable. The diversified ones can hide weak companies in the mix. Pattern interrupt 7 if you want real passive income. You need to think differently. Dividend investing isn't about finding the highest yield. It's about finding reliable cash flows that you can count on for decades. Large-cap dividend aristocrats, companies that have raised dividends for 25-plus years, offer modest yields, usually 2-3, 5%, but they're backed by real business strength. Some small caps can offer this too, but they are not the ones trading at $10 with 11% yields. That's the opposite of business strength. That's a distress signal. The investors who get wealthy from dividends aren't the ones chasing the highest yields. They are the ones buying reliable payers and letting compounding work for 20-30 years. They're boring, they're predictable, and they win. Pattern interrupt 8, so here's my challenge to you. Next time you see a small-cap dividend ETF under $15 with a 10% plus yield, instead of buying it, ask yourself, why is this yielding this much? What's broken? Dig into the holdings, look at payout ratios, check dividend history, see if these companies are actually maintaining payouts or if they're just one bad quarter away from cuts. 9 times